Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, November 15th, 2022. It's 10:24 Eastern Time as I'm starting the video. This video will be, we'll cover, we'll keep this one limited to the equity markets. I do want to cover today and or until tomorrow, I want to cover all the major asset classes, which are stocks, bonds, gold, precious metals. We'll kind of lump into one there, crypto, and of course maybe a little updates on commodities. I probably should show you. Probably should start there. I want to focus on the equity markets here, but I do have divergent lows in the crude oil right now, and also natural gas. So that could continue to stall out that energy sector short or not. Again, yeah, that thing's taken on its own merits. I still like that, and I still think it's, if nothing else, it's been a good hedge between being long tech and short the energy sector. As mentioned last week, because the tech sector had the most constructive charts, and the energy sector the most attractive RR to the downside, and with a hedge trade, you just have to have one go up more than the other. So if your longs go up more than your shorts go down, then you're making money. Or even if your shorts go up, I should say, if the longs go up more, that's how a hedge trade works. But I just wanted, this wasn't the point of this video, but I do see a pretty nice divergent low in CL crude oil futures. This is a 60-minute chart. There was our primary uptrend line. We kind of chopped through it a little bit there, but regardless, it's these 60-minute divergent lows and highs that typically are good for the swing trades. And so far, it's running, but it's at resistance right now. So I'll do a further dive into the charts later and give you more of an opinion there. And on natural gas, I just wanted to mention that on the 10-minute chart, for this is a swing trader time frame, the active trader time frame, you had divergence there as well, down to that 5.876 support. And now almost the makings of a downtrend line there. If we can get pop that, there might be a little more upside there, but then the bigger picture too, you want to look at this. You've got, if I go back, I think 3 months will show me here. Yeah, there it is. There's a pretty significant uptrend line right here on natural gas futures, where we've hit numerous times. We keep pulling back to that uptrend line. So a break of that's going to be bearish, but if it can hold it and continue to work its way up, and you could probably see another thrust up here to at least that 6273 area. Okay, I only threw that out there to get a brief update in. Let's talk about the equity markets. I'm not going to go over a lot of individual stocks in this one, but certainly want to do an update on Walmart, because that was the biggest. It is the biggest retailer out there, and they reported today. The market liked what they heard. I think they're implementing a stock buyback program. But look at that, a perfect back test. And that's what I said could happen. You could back test a trend line, keep back testing it, and as of now, that's all that is. So I'm going to say it this way: that is, it is an objective short entry. It would certainly not go long on a 7%, 7.3% pop into resistance. Remember, we have significant price resistance right here at the blue line, about 153. You have a lot of, that's really pretty much what's capped this stock at all-time highs. We had one false breakout there. It came with a small divergent high, a little wedge that broke down, and as I often say, fewer things are more bearish than a failed breakout. And that's what that was, aka bull trap. When you have a well-defined resistance level, you pop to new highs, it sucks in new longs, scares out the shorts, and then boom, big drop there. And so that drop also took us down below, as I've covered in detail yesterday, the primary bull market uptrend line. We bounced, and now we bounced to it again, back testing from below. So you have a confluence of resistance there, about 153. And there's no other way to spin it other than bullish if you take that level out with conviction, because you take out both price resistance and the uptrend line as well. You recover that, and of course you have that previous high, and then that's it. And then there's no overhead resistance after that if that level is taken out. All right, so I don't want to spend too much time on this one. As I said, it was, I wouldn't have gone long or short before the before earnings, but when you look at it from a weekly chart, you can see that same back test of the trend line there. And then on that weekly chart, as mentioned yesterday, you had the big, big negative divergence. This whole thing right here and here forms a rising wedge where I drew the divergence line really from this point. We've been diverging for a while with little corrections, and if you take the widest part of the wedge from right here to here, from that last divergence, add it, that's what that is. That gives you a measured target. I already had that level there yesterday in the video at 127 cents, and that would be the measured target of the wedge. So this is how I suspect Walmart to play out. I'm still going off the primary theory here that this is a bear market rally, and I'm going to give you some bear market rally targets. But based on the scope of these divergences, it would appear that the correction is not over yet. If you look at any type of wave count at all on a weekly, that's a single wave down. That's just a matter of a couple of weeks there. The stock drops. So you look at larger wave counts. It could be your primary wave 3 somewhere down to there or there. And ultimately work our way down here with a 5-wave, primary 5-wave count. An Elliott wave, the wave P3 is always the biggest on a 5-wave primary count. So that would be what you'd be looking at there. And look, if we go up, keep it simple. There's no, like I said, I'm not shorting this one right now. I'm going to hold off. I'm going to give you some other levels I'm watching on the indexes, keeping it light there for now. But 152.75 again, and that level I showed you there. If it pops that, then that's bullish. And then if it pops it and has another failed breakout, then that's it. So what you do is you wait till the breakout fails, and then you enter a position if that's your thing to short Walmart. At least earnings are out of the way now. But let's go back to the equity markets. Let me start with the Wilshire, and then I want to go over, I definitely want to do an update on the small caps. I haven't covered those in a while, but the Wilshire 5000 is probably the single best measure of the stock market, because you have all sizes market caps. The S&P 500 is better than the NASDAQ 100 because it has more sectors included. It's more broadly diversified, more representative of the U.S. economy. However, it only has your mega cap corporations. It doesn't have your small and mid caps, which actually make up, there's a lot more small and mid cap stocks in the universe of stocks, many more than there are mega caps and large caps. So and this one kind of hits them all. And here's the main takeaway. You have the primary downtrend line right here. You have, at this point so far, well, you have your initial reactions there, distinct reactions there, the third clean reaction there, and we're a little shy of that. So what I'm doing in this video, what I've done for you, is giving you, I've kind of boxed in, all along since we put in these divergent lows. Not more than a couple days has gone by. Probably mentioned dozens of times since then. Potential if these divergences play out to bounce, and I give you bounce target range. As I talked about the primary downtrend lines on all the indexes, they don't all line up, so it's more of a range. You'll look at the S&P 500, the NASDAQ, the small caps, but you have similar downtrend lines, and you also have the big 200-day moving averages, which on my chart here on the daily are in the red and blue lines, both the simple and exponential, and they come in. So when you zoom in really tight in that purple box, you can see the bounce target zone. We're pretty much at the bottom of it because we're at that 200-day. Sometimes the sellers step in and sell bounce backs to the 200-day exponential. That's the red line. Sometimes they step in and they sell the 200-day simple. And it's not unusual to see, especially when you're looking on a daily time frame, to see a one or even a few days popping those levels only to see them fail like you did right there. If you can see, there was the 200 right at the tip of my arrow there, the 200 simple. Took it out for a day, remained above it the next day even though we closed red, then fell back below it and then couldn't regain it, and that's when that big leg down came. There you had almost a perfect tag, but the seller stepped in a hair early. So again, these aren't precise approximate levels. They're kind of more of a gauge, and that's by most metrics. When these things turn down as well, simply looking at the slope of the 200 days will tell you what the larger trend is as well. So in a primary trend right now, just about every metric that I use, most but not all of the longer term indicators are on sell signals and saying it's a bear market. Bear market rallies, this is what they look like and feel like. So that's it. So the range, I also have a box here at 420. 42 323.70, so we'll call it roughly that 42 325 or so, and that's pretty good price resistance. So that's it. And the range, by the way, is not very large. We're just a hair below the bottom of it now, so for all intents and purposes close enough, and it ranges up to about 4.75% from here to the top of the range. And if you look at one other chart here, let's go to board 5. I gave you this. This is the same range, and you can see where the Fibonacci clusters line up from the all-time high. The Wilshire peaked back in November, like the NASDAQ 100 and the small caps, a lot of other things, and effectively put in a double top in the beginning of the year, right when the S&P peaked. So I think it'll go down on in history, on record, it's that being the start of the bear market. But again, it's either one. It's a double top. And so you measure down from the peak high, the highest high, into the recent low. And here's your Fibonacci's. I know you can't see them in the video. I can't make them any bigger on this charting platform, but that's 38.2% and 50%. And that's exactly, you remember, well, you don't have to remember, I'm telling you. How I start by doing this is looking at moving averages and price resistance levels and other things. That's where that box came from. Then I went to the fib board here and put it in, and you can see how perfect those levels line up. And that is, there's no be-all, end-all. A typical counter trend rally will range usually from 38.2 all the way up to 61.8. So if we take out the top of that range, does it mean the whole bear market scenario has been eliminated? No, not at all. You still have, this is a major reaction high, and that also comes in right around where the 61.8 fib does. So if I want to make the box bigger, we can do that. And sure, if we get through the top of it, I'll be talking about that at the time, that, hey, we still have a reaction high here. We still have a 61.8 fib. But as of now, I think this is the most likely scenario. And there's no hard sell signals or anything that tells me, we're going to get rejected here at the bottom. I can't say with a high degree of confidence, but it's certainly in the realm of a likelihood. So, like I said, we're from here on up. I think the easy money's been made off the bottom, and it's going to get a whole lot harder as we start hitting. As we come into these 200 days, you're going to see sell programs kick in, profit taking happen, pullbacks, probably more of a grind, if you will, if we do grind up to that top area. Okay, and then the S&P 500, let me just add that box here. I'm still on that fib board, so it's pretty much the same thing. I've talked about this since before we bottomed here, that the next run up, this would where the markets would likely carry to if those divergences play out, and they've certainly started to play out. And you could say they've played out at this point. We've rallied enough here in the S&P 500, but you have right here again 38.2% key Fibonacci retracement. We're right at that right now on the S&P 500, and we're also at the 200-day exponential moving average of the red line here. I'll zoom in a little bit. So you have a confluence of resistance. Again, I'm going to show you a little different version of it because we have the 61.8 all the way up here. So really, let me just show you. We'll just put the box here. That's, there's your probable bounce target zone, and we're at the bottom of it now, and that means we could, the odds start to go up sharply here that this could be it, or we have a little more upside coming. And let me show you the other board with price levels. So here I've made the box red. And you can see it has that same thing. It has the S&P 500 also has a nice clean downtrend line off the highs. The only one that doesn't is the NASDAQ. You have distinct reactions here at the end of December, beginning of January. Distinct reactions there. Those were also rejections right here at the 200-day moving average. We had about a week or so we got above the 200s there, but then got rejected. But at the same time, the NASDAQ was getting rejected on its 200, and that's why I That's why I cover multiple indices, even if I'm only trading one at the time, or even none. If I'm just trying to get an idea where the market's going, you look at all of them together. And so this is a major downtrend line, comes in right in that box. And the 200-day exponential sometimes does the trick. And you can see we're right at that right now. So we're there at the 200 exponential. We're also right around a hair above the 38.2 fib. And so this is the box, and the box doesn't really range that far. Now I do have a yellow line up here at 428.64, and that one, let me see if that comes in with that fib level there. Yeah, there it is. I have it boxed in, so that you can see this is again the S&P 500 with fibs. There's the 61.8, and it comes right at that previous reaction high, and that's about 430. So that's pretty much the maximum. And what I mean by that is, look, we can do that and then go down, but what happens is the case that that it's a bear market rally with another leg down to come versus the market going much higher, you start to take out previous reaction highs. There's one right there. There's another one on the way down, and that's a major reaction high off that bear market rally. And so this is where anything is possible, but the probability of us turning around and going down starts to diminish with each tick higher from that point. So again, if I had to put a line in the sand, it's right here. It's about 430 on the S&P 500. I don't think we're going to get that high, but based on the positive divergences, sure, it's possible. It's very, very possible. But this is my likely reversal zone. So I'm just make a purple box here and show you that, you know, if we keep going higher through there, we'll color this one up, and like I said, I'll make that purple, and stands out a little better, that color, all the way up there. And it's about, I said 430, so that's 428.64. We'll call it 430 because that's closer to that reaction high. So, you know, to put odds right now today, I'd say, I don't know, somewhere in there, probably you know, 60-70% chance that this box, top of that, caps the rally, and you know, a little bit less than that there, and anything left over, you know, the market may want to say the bear market's over and we go to new highs. Certainly possible, but it doesn't look that way to me right now. Okay, here's QQQ. And you see QQQ, the downtrend line, that's the original one that I've had, but we had this false breakout here. It's hard to see. I have so many lines here on this chart. If I turn it off, I'll draw them out for you, and you can see them better this way. You had the best I could draw it here, a trend line coming off that high. That's probably your most accurate trend line right about there. Coming off not the very high. Technically, that was a high again back in November, but you'd have to cut through these. So you start on that slightly lower high around the beginning of the year when the rest of the markets peaked, and come on down somewhere around there. And so you can see when I put on the box, the trend lines come in together. Also, the 200-day moving averages are right up here. So remember, the Nasdaq, the tech led this thing down, fell more to the downside early on, pulled the market down with it, and so it has more catching up to do to get back to its 200 days. And you can see here, that's what capped the previous rallies since the bear market started. We had that rally in the beginning of January, 2 rejections there at the 200-day, another rejection right there, and this one you can see got rejected just above the 200 simple and fell shy of the exponential. And right now they're coming in close together. And again, I use them both because some traders like the simple, some like the exponential. Therefore, I like them both because you know, you need to watch them both because some traders will sell one, some will sell the other. And that's it. So to measure it up there from where we're at right now, to kind of put it in perspective, it gives you about up to the 200 simple, the higher of the two, about, depending if and when we get there, we'll call it about 5.5% or so, unless we shot straight. Yeah, it's still 5.5%. And that's pretty much the max upside I see right now. And you can see they're boxed in. That's the red box. That's the most likely. And, you know, if we're going to retrace more, now I don't favor this, I'm going to say it, but if we were to bounce a little bit more, you can see the fibs up here. You have the 38.2, which comes right in with the 200-day moving averages. The 50% fib is up here at that previous reaction high, and that's about the high end of where I'd expect it. This is a 61.8. I don't think that's going to happen. If it does, we're probably going to new highs. That's my guess, because we've clearly taken back the 200-day moving averages and taken out the fib. So I expect tech to overall continue to underperform in the bear market. Bigger picture, just near term, it got beat down the most. And again, we had so many hitting, some key support levels and big divergences. They were the most constructive charts out there. All the big fangs had positive divergence, or most of them did. A couple just started to burn through one or the other. And so that's it. Hopefully that makes sense. And you can see they're kind of, just like back here. Remember, we had a bounce target zone at the time I laid out all the way back here after coming off, reversing off those lows and riding up that rally. And we hit, if you can see it, about the bottom third of it we went into. And that was also just a brief few days. We traded above the 200 simple moving average, and I'm sorry, the 200 exponential, and still fell shy. We went about third of the way up to the 200 simple and a little bit above the 200 exponential. Okay, so that's that. And then finally, IWM. I really wanted to talk on this one. I haven't really covered IWM much lately. And if you if you share the mindset that I do, that this is most likely still a bear market rally with another leg down to come, then this is the point, because we're hitting the bottom of those likely bounce targets where you may want to start scaling into or back into shorts or out of longs. One thing you can do also, if you have longs, trail them up, trail stops up, protect profits, let it run. The bid's been pretty aggressive lately. But you can see on the IWM, the Russell 2000, you have also just a beautiful trend line. So it's really everything but the NASDAQ 100 where you have to, cut through a few candles. I will have to say that this one would need a rejection here in my book to validate the trend line, because I always say any 2 points can be connected at random. It's that third reaction that helps to validate a trend line. With that being said, it's not just a trend line. You're also, I'll turn off all these lines here. You're right at or in close enough proximity to both the 200 simple and exponential, which you're pinching right now. So you can see you had it there. There was a rejection at the 200 simple right there, right? A perfect rejection at the 200 exponential right there. Rejection at the simple, and the exponential acted as support. They both did on the way up. And then once you break them, this is where you broke that moving averages. It came back test, rejected, back test, rejected. Rally, back test, rejected. Back test, rejected. Back test. Okay, that's it. It's you really can't overly complicate it. It's just one of many factors, so it's not a hard short at this point in time, because sometimes you take those levels out for a week, couple weeks. Sometimes you kiss them and then reverse, and of course there's always a chance that, hey, maybe we just keep on going up through there and take out this previous reaction high. But let me so again, to keep it very simple, you have a confluence of resistance right here on IWM, and to me it's probably offering one of the better RRs for shorting right now, for establishing swing positions, because you have both the key moving averages, the 200-day moving averages, and downtrend line, and price resistance. Remember, this is a level I've had here all along, 190.40. It was a big level. It was a reaction from above right there. Numerous reactions from above there. Finally, that level broke. Once it broke, they tried to back test it right here for about a week, and then boom, got rejected off there. They ran up again, tried to recover it. Boom, another smackdown. Finally, and of course, we went long there. That's the first time targets were hit. We caught that rally. We rallied back up to the 200s, took it out briefly, but then failed it again, and now we're back there. So enough reactions over the past year, actually 2 years, to say that that's still a significant level. Let me take a look at my fibs real quick. Fib clusters right here, what you're looking at. You have fib clusters. You have the yellow lines measure the entire move down off the highs into the low, and that one is Let's see, I've got a couple fib lines here, and it's hard to differentiate. I think we have the 50% retracement of this reaction high down, and then we're at the 61.8. These two lines right here, that's what I'm talking about. The 61.8 from this last move down, and then the 50% from that move down. So those are your fib clusters there for IWM. And I'll just wrap this up with the futures real quick. We have RTY, or your Russell 2000 small cap futures, so it's the futures version of IWM. And you have a resistance zone here. I have reactions here from above. From above. Reactions there from below, rejected. We have a reaction right here, reaction high. And so that's a resistance zone that runs from about 1911 up to about 1928 or so. And you can see, as I pointed out yesterday, we're starting to diverge. And we had 60-minute small divergence yesterday. And it gave us a small, decent, certainly a tradable pullback. That was a couple percentage points at least, about almost 2%. Let me just get rid of that line. Get rid of that line. Didn't mean to put that one there. And that divergence has gotten larger now. It's at this point still potential divergence at this time because the PPO is pointing higher. So if the PPO turns back down, which I expect it to, anywhere we're right at the bottom of that resistance zone. So anywhere from here up to the top, you're going to have a nice, pretty steep divergence on the 60-minute chart. Last time we had divergence of this scope was right here. You can see that was the last negative divergence. You had a nice wedge right here, and from that you got a nice correction. So that's the outlook for RTY. I wish I could draw a better uptrend line, but I can't. I like when I have clean uptrend lines in which to trigger an objective short entry, because I always say divergence is not a sell signal, but you know what is? Not necessarily a sell signal, but an objective short entry is a rally into resistance. So I showed you on the IWM daily chart resistance levels, and here's some on the futures. And I just jumped out the same chart, but I took it out to 6 months using 2-hour candles just to show you that resistance zone right here. It goes back even further than I just showed you on the 60-minute chart. You have all these reactions back here when you had this wedge back in May. May and into early June. So you have a lot of reactions there. It's a significant resistance level. And here for kicks and giggles, I'll put up some fibs for you from the recent low. Grab that low, come to that high, and let's see. We're above the 61.8, but below the 76.4 fib right there. So more so price resistance on RTY right now. And then let me show you NQ and ES. NQ is the NASDAQ 100 futures. Remember, we took out this primary downtrend line recently on the futures right here on this impulsive leg up. As I pointed out, we had a small divergent high the other day, gave us that pullback, small pullback. It was right there, and that divergence has grown larger now, just like RTY. But you need to turn down here on the PPO. And so far this morning we got rejected right on resistance. This is the line I had on the previous charts that I've highlighted here. 12,110.75 is the number. And like RTY, it's more of a resistance zone, but that line there, the 12,110, is pretty significant. You have a lot of reactions there. And so if we can turn down now, it's going to confirm this divergence, and that still has the potential to send us back here to at least that 11,540 area, and potentially a back test of the trend line. This is our largest uptrend line right here off the bottom. So that's where we're at on NQ. I want to show you some fibs on NQ because that's interesting. They to the button this morning. This is the high right here, the mid-August high, major reaction high. If you measure that down into the recent lows, right here, this is a perfect 50% retracement, Fibonacci retracement in the NASDAQ 100. This is the index that most traders are trading and watching right now, the NQ. So we had, we were bouncing at, this was price resistance and the 38.2. And from right here, you have to measure from that point. So that was the first tag of the 38.2, and this is where traders step in and they sold it. They actually sold it all the way down to here. So, and I believe I pointed out at the time it was definitely a short pullback trade. And now we've rallied up and we hit the next Fibonacci retracement level as well as some price resistance. So it would make sense to see some sellers step in here. And if they don't, there's your 61.8, the next fib retracement. So I just use fibs in conjunction with price resistance. Let's look at ES and we'll wrap this up. ES is the S&P 500 futures, and the same thing. There's a retracement from that's the mid-August high measured down into the lows. This is a 61.8. Remember, the S&P 500's been stronger than the Nasdaq. It's held up better because you have more defensive issue stocks, so it didn't drop nearly as much. The Nasdaq 100 got much more oversold, led the way down. Therefore, even though it's stronger right now on the way up, it still has a lot more ground to recover, and that's why you've already retraced. Which is also, remember, this is not the bear market high right here or the previous bull market high. This is just the mid-August high, so that's just a single fib retracement. But interesting enough, we're at 50% on the Nasdaq 100 futures and the 61.8. So that's dual. Two of the biggest indexes that hit fib resistance today. And let me step it down to a 30-minute chart or a 60-minute chart. Let's do hourly candles. And you can see there the same thing. You had the primary downtrend line on the S&P 500. We had a breakout the other day. It's been a strong move. We're getting pretty overbought on the near term 60-minute chart here. If you draw a line right here about where the RSI recently peaked, the last time you got this overbought in the bear market was right about here, and we obviously didn't go up much higher before the next leg came down. So we're overbought, and remember, overbought in itself is not a sell signal. Nor is divergence. I wish I had a better resistance level here on ES. I don't see a great one other than that fib I showed you, but we do have the potential negative divergence. So if we start to roll over today, which I think is likely, then that will confirm that divergence. And remember, a 60-minute divergent high like this is usually good for a tradable pullback of at least 3 to 5% at minimum. And so that could easily send us back down for back tests of the trend lines. Otherwise, the bid has been voracious. It's possible they can burn through these divergences or take it up higher. Look, if you take these lines, keep in mind you can extend the divergence lines, and the S&P 500 and the Nasdaq have plenty of room to thrust up and hit these next. I'll tell you where the next good price resistance doesn't come in until about 41.29 right here on ES. And again, you can see that I already covered SPY for you. So those are the levels to watch. The only other thing that I did want to cover in this video, because it's related, is the VIX. I do cover that from time to time. And big picture is this. When you look at the weekly chart, this goes back for years. So back in the back in the 90s and early 2000s, this is pretty much where bear markets ended and big corrections. Level right up there, those spikes on the VIX. Then we entered a new era of unseen. This was record low volatility right before the last bear market, the last real bear market, 2007 to 2009. And as always, before the market, that was in late 06, and then the VIX started trending up to just before, right about to the same levels it did back here when COVID hit and when this bear market started. This one started back here. Then you had this spike up here. This is the main thing to look at. These spikes came not at the very end, but almost. They came, usually it was a few months before the bottom, or in the case of COVID, it was actually because the Fed didn't let the bear market happen. It was very fast. This one came in that last drop in November of 08, where the Nasdaq bottomed, and then the S&P had a slightly lower low in March. But either way, if you would have covered all your shorts and gone long there, you might have been a little early on the S&P. You would have been nailed it on the Nasdaq 100. But even if you went early on the S&P, the drawdown was pretty much minimal from that point. And again, they're perfect tags at that level. And since then, since the last bear market in 07, 09, this is where the corrections ended. Even that big Q4 2018 drop, and right there, that's where the VIX correction levels ended. But this is where bear markets end. And that's why this thing so far, all we've done is hit correction territory as far as this goes. And technically, the market's entered a bear market, dropping more than 20% if you want to call it that. But again, this is something to watch. And here's a trend line too. Here's an uptrend line. So if the VIX continues to drift lower, let me drop down to a daily chart and show you what I'm watching, and even a 60-minute chart. So here's the levels, 37.61. That's big resistance right here. We can go back all the way into late 2018, 2019. Remember, that's where the big Q4 2018 drop ended. And we've had these spikes up here all associated with stock market drops, corrections. But that's the level, and I've said it a few weeks back, we need to pop this one, 37.61. When that pops, we're probably going to rip on up and have that last leg down, at least a lasting bottom that's a more tradable bottom, in my opinion, where you can, take 401k monies, put it in there for at least several months, if not more, trade what still may prove to be a larger bear market rally, but within a bigger bear market. That still, we haven't taken out that level, and so this is one of many metrics that show me, this isn't where bear markets in the last couple decades have ended. They haven't ended here. They ended up here. I showed you that on the weekly chart a minute ago. And then you want to nail the entry here. Go down to a 60-minute chart, and you can draw these nice clean downtrend lines right here. This chart to me looks like an EKG. You can see, these blips up, and you have pretty well-defined downtrend. This is your most current downtrend line. And when these blips occur, here, I'll show you. We'll put up edit chart properties, comparisons. Let's just throw the NASDAQ 100 on top of this. And you can see right here, when you get these breakouts on these downtrend lines, that's when the NASDAQ has its next leg down. You get a breakout, boom, the NASDAQ dropped. You get a breakout, the NASDAQ dropped. You get a breakout, the NASDAQ dropped. So I have a price alert right now set for this one. When that pops, and the thing about the VIX, it doesn't play around. It's kind of like natural gas. There are periods where it will consolidate around for a while, but it's usually full throttle up or full throttle down. So for the most part, you can see it, spend some time sometimes consolidating with the stock market. But when you look at it again, like an EKG, you get these blips up, blips down, blip up, blip down, blip up, blip down, blip up, blip down, blip up, blip down. So the support ranges aren't, they're sometimes you can make it all the way down. This is the low end of the range in recent months, really since the beginning of the year. But in a bear market, if you take it a step back, this is what happens. See, the stock market peaked to the NASDAQ 100, everything else back here in November. And what happens, you start making higher lows in the VIX until the whole thing's over. So there's that resistance level we need to pop. And each of these lows so far is higher than the previous one. And that's why, going back to this chart, it's possible to get down here to that 20-ish level again. But as I just showed you, when we step back a little farther out, you can see each time we tend to make a higher low, and then we pop. So looks like the next one's coming, guys, coming here soon, and that's why I think it's a good time, whether it's just a pullback trade for you or you want to prepare for the next leg down in what could be a bear market with more to come. And then, of course, keep in mind too that all of this, it was the rally here was preceded in 110%. The case was made, if the markets wanted to rally, that they would rally with positive divergences on the 60-minute, daily, and even weekly time frame. Again, something I said we haven't seen for years, and something that is often the catalyst for new highs in the market when you're in a bull market. But in a bear market, you're likely to get at least a rally, and that's what we got off that. However, fundamentally, what's changed in the last few weeks since we bottomed? Well, Powell hasn't said anything. They always have the minions. I think it was Brainyard, it's her name, or something, came out and saying, oh, well, we may be able to ease off. We know that the Fed's not going to raise forever, so that statement means nothing. The market has seemed to price in that the Fed's going to pull a 180. We know they're not going to raise 75 basis points forever. That's a given. So I think the market right now has priced in a lot, if not all, or most of what the Fed may slow things down. As I said, we knew they were going to slow things down. Things are breaking. The Fed, as critical as I am of them, and as much as I think that they don't know what they're doing, and the folks in that board should not be controlling, the central bank and have the power that they should. I think there should be well, let's just say different folks running the Fed. But the Fed does what the Fed does, and they've always been reactive, not proactive. But where I'm going with this is, I think they will see, and it's a matter of what's going to happen between now and I believe it's December 13th. Remember, they don't meet again until I think it's the 12th and 13th, the next FOMC meeting. And so on the 13th, if memory serves me correct, it'll be 2 p.m. They'll make the rate announcement, tell you what they're doing, what their thoughts are. If we don't have any other blowups, I still expect them to, back off a little bit. At most, maybe another 75 with firm statement. They're going to sit tight. Probably do a little less. But again, here's the thing, guys. There's a lot of time. It doesn't seem that long, but we have almost 1 month, and a lot in this market can happen between now and then. And we've already seen the cracks that I've talked about and others have talked about. We've seen it in the UK gilt market and their pension plans. We've seen it now in crypto. Bitcoin's still below key support. And so with FTX blowing up, what's next? So if we get nothing else, if everything stabilizes and crypto gets back above support, and we don't have any other major blowups of anything, that's going to give the Fed room to be a little more hawkish. Any other cracks, any other big thing is not going to give them that room, and they are going to have to then cow down. But the bottom line is the market is rallying now because we had a slightly cooler than expected CPI number, but still by most all historic standards extremely hot number. And so the market's rallying on that. So between now and then, we'll continue to watch what commodities do. Anything we can try to glean from the real estate market, which again the data is a little more lagged there, rental costs and housing, and of course any big shoes to drop. So the perfect scenario for the Fed is no more shoes drop if they want to keep hiking. No more big cracks in the system. But remember, there's also a feedback loop that I talked about, that whole negative feedback loop where the more the stock market rallies and the more it rallies on the expectation the Fed's going to cut rates go down or they stop going up. Remember, the Fed pivot can be just less up or stopping, holding off and seeing where things go. But then that will then continue to fan the flames of the inflation with commodities, mainly DJP. We look at DJP and commodities still being solidly in a bull market after ending a bear market that started back in 2008 during the last financial crisis. An unusual bear market. Usually commodities go up with the stock market. They go up with economic growth. But we had a deflationary period after that. There was a huge debt bubble that popped, and that had deflationary effects that offset all the money printing and everything else until it didn't anymore. And so now we're in what appears by just about every metric early stage bull market action. And so again, this will be the negative feedback loop for the Fed. Every time they start to back off a little bit, next wave up in the commodities bull market will resume, inflation will pick back up, and the Fed will then have to get hawkish again, which in turn would of course send the stock market down again. Okay, doke. I'm gonna wrap it up here, and like I said, I'll work on gold, crypto. Not much to add really. I don't think it warrants a whole video. Let's just keep it simple. Bitcoin has a massive support level, former support at about 18,230, which it's trading below. If it gets above it, great. And the higher above it, the more bullish. If not, it's in a bearish posture right now, and I don't know the impact. All I know is a lot, and I mean a lot of institutions have their hand in crypto, and so therefore, what's is there going to be another shoe to drop? Um, don't know. So we'll see. But the longer this stays down here, and or the more it goes down, the higher those risks are of some other systemic event in the financial system. So we'll watch this as well. All right, guys. This has been Randy Finney with Right Side of the Chart. Have a great day.